All right, let's talk about the big one, the $500,000 dividend lie. You see it all over the place, right? This idea that $500,000 in dividend stocks is your golden ticket to freedom, forever. It sounds incredible, but what if I told you it's a dream that could actually be setting you up for a massive financial fall? We're going to get into the real numbers behind this.
So listen to this. If you think that $500,000 is enough to quit your job forever, you are walking into a mathematical trap. And that really gets right to the heart of it, doesn't it? I mean, look, having $500,000 is fantastic. It puts you way ahead of most people, no doubt about it. But the internet has turned it into this cheat code for instant permanent retirement. And here's the thing, the lie isn't that dividends are bad or fake, not at all. The lie is that we're being told we can do it with a lot less money than we actually safely need.
Okay, so let's really break this down. Why is this idea so seductive? I mean, what's not to love? The promise of passive income just rolling in every month, never having to touch your original savings. It sounds like the absolute perfect financial dream, right? But here's the catch. It's a dream that's often built on some seriously shaky math. I'm sure you've seen this pitch. It's all over the internet. You grind it out, you save up $500,000, you find some magic portfolio that yields 8%, and boom! Just like that, you've got $40,000 a year without lifting a finger. On paper, the math is perfect. 500,000 times 0.08 equals 40,000. It's so simple you kind of scratch your head and wonder, why isn't everyone doing this? Well, the reality is that calculators don't live in the real world. They don't have to worry about recessions or companies cutting their dividends or that silent killer we call inflation. What looks like a rock-solid plan on a spreadsheet is actually a massive, massive gamble. All right, so let's pull back the curtain. Let's talk about why this dream so often crashes and burns. It really all boils down to one thing, the danger of chasing high yields. It's about ignoring the most fundamental law of investing. There's no such thing as a free lunch. High reward always comes with high risk. Okay, take a look at this, because this chart really puts things into perspective. That 8% you see on the left, that's the internet dream yield. It's a total outlier. Now, as you move to the right, you see reality. The S&P 500, the bedrock of many portfolios, yields somewhere around 2%. A collection of really solid, safe dividend stocks, you're looking at maybe 3 to 4%. So to get from that safe 4% all the way up to that risky 8%, you have to double your yield. And let me tell you, that usually means you're taking on way, way more than double the risk. And that brings us to a super important concept you have to understand, the yield trap. You know, a stock doesn't just magically yield 8% or 10% because it's generous. There's almost always a reason. And that reason is usually that the market is screaming, this company's in trouble. The stock price has fallen, which makes the yield look high. So when you reach for that juicy yield, you're not being a clever investor, you're often just catching a falling knife. And this is exactly how it can destroy your savings. Let's walk through it. Step 1. You find a stock, maybe it's at $100, paying an $8 dividend. You buy it, feeling like a genius for locking in that 8% yield. But then, step 2, the stock price starts to drift down to $90. You think, no big deal, I'm still getting my dividend. Then, step 3, it sinks even further, down to $80. And by step 4, you're hit with the cold, hard truth. Yeah, you got your dividend checks for a little while, but your actual wealth, your nest egg, has completely collapsed from underneath you. But okay, let's say you get lucky. Let's say you somehow manage to avoid a classic yield trap. There's another, much quieter, more insidious killer that can absolutely wreck your retirement. Even if you found some magical, stable 8% yield and it never got cut for 20 years, you'd still probably go broke. Why? One word: inflation. See, here's the problem. Most of those super high-yield investments, they don't grow their payouts. They're just flat. And if your income is flat, but the cost of everything else is going up, your real-world purchasing power is getting crushed year after year. This chart says it all. That 40 grand that buys you a decent lifestyle today, in 10 years, it buys you less. In 20 years, even less. It's like you're on a financial treadmill that's slowly grinding to a halt. Inflation is eating your retirement alive. Okay, so I know this sounds a little bleak. If chasing high yields is a trap, what's the right way to do it? What's the alternative? Well, this brings us to a much safer, much more robust strategy, one that's backed by decades of actual research. And that's focusing on total return.
Now, you've probably heard of the 4% rule, but here is the single most important distinction that so many dividend-only investors miss. Listen closely. It is a withdrawal strategy, not an income strategy. Let me say that again. It's about how much you withdraw, not how much income your portfolio happens to generate. It couldn't care less if your portfolio yields 1% or 5%. It's all about the total growth of your money. That's your dividends plus the growth in the stock's price. And I know, the idea of selling shares can feel wrong. It's terrifying for a lot of people. It's probably the biggest mental block investors have. We're conditioned to think our asset is the number of shares we own. But the mathematical truth, the only thing that actually matters, is the total value of those shares. I mean, ask yourself this. Would you rather have 1,000 shares that are worth $10,000 or half as many shares that are worth $20,000? Of course you take the second one. That never sell shares mindset is an emotional comfort blanket. It feels safe, but it's not a real strategy.
So what makes this total return approach so much better? Well, for starters, it's built to fight inflation from the get-go because your withdrawals actually go up with the cost of living. It also frees you up to own the world's best companies, the high-growth innovators, not just the slow-moving, high-dividend payers. You're also in control of your taxes. You decide when to sell and take a gain. With dividends, the company decides when you get paid and when you get taxed. And believe it or not, this strategy is often more resilient during a recession. Which brings us to the million-dollar question, literally. If $500,000 isn't the real finish line, then what is? Let's talk about the real freedom number. Yeah, this is the question that really matters, isn't it? If we can't just magically force a small portfolio to do the work of a big one by chasing risky yields, then we have to be honest with ourselves about how big a portfolio we actually need to build. So for that same $40,000 a year income, the real number you should be aiming for is $1 million. And look, I know that can sound discouraging. It's a big number, but it's not a number I just made up. It's based on decades of real market history. Trying to pull 40 grand from a 500K portfolio, that's an 8% withdrawal rate. And historically, an 8% withdrawal rate has an almost 100% chance of failure over a 30-year retirement. It just doesn't work. So how do we get to that number? It's actually based on a really simple and powerful formula called the 25x rule. It just means you need to save about 25 times your desired annual income to retire safely. So if you want $40,000 a year, you multiply that by 25, and there you have it, $1 million. This simple math is the foundation of a retirement plan that can actually survive contact with reality. You know, to make this crystal clear, let's just tell a story, a tale of two retirees. They both start out in the exact same spot, but because they choose two totally different strategies, they end up in dramatically different places just 1 decade later. Okay, so at year 0, person A and person B both have $500,000. Person A, chasing that high yield, decides to retire immediately. Person B decides to be patient. Fast forward to year 3, a recession hits. Person A's high-yield stocks get hammered, their dividends are cut, and they're forced to sell off their investments at the worst possible time, just to pay the bills. It's a death spiral. Meanwhile, person B keeps working and investing for total return. By year 7, her portfolio hits that $1 million mark. Now she retires, using the safe 4% rule. And by year 10, person A's portfolio has shriveled to maybe $300,000, and they're probably looking for a job. But person B? Even with her withdrawals, her portfolio has grown to around $1.3 million. She played the long game, and she won, big time.
And that's really the ultimate lesson here, isn't it? The market rewards patience and diversification. It punishes impatience and putting all your eggs in a few risky baskets. Chasing high yields is the impatient strategy. Building a solid, diversified, total return portfolio, that's the patient strategy. And the market almost always rewards the patient.
Now, does all this mean that hitting $500,000 is useless? Absolutely not. Far from it. It's an incredible achievement, seriously. It just buys you a different kind of freedom than you might think. It might mean you've reached what people call coast-fi, where you don't have to save another dime, you just work to cover your bills. It might give you the freedom to quit that high-stress job for something you actually love. Or maybe you do Barista fire, work part-time for the fun of it and the benefits. The key is to see it for what it truly is, a hugely powerful milestone, but not the final destination. So I'll just leave you with this one question to think about for your own situation. Are you sacrificing your future capital for today's yield? Because it is so much better to work just a few more years and let your portfolio grow safely than it is to retire a few years too early and risk losing everything. Don't trade the secure future you've worked so hard to build for the illusion of a shortcut today.